John, I appreciate you doing this. Let's see if we can we fix the world, do you think, in 30 to 45 minutes? Solve everything and
Oh, 45 minutes, easy, Mike. No problem at all. Anyhow, it's good to meet you.
I've been following you for a little while now, and the work that you're doing is extremely important. And I thank you for making yourself available to talk to me.
Oh, my pleasure. Thanks for having me on.
So I want to get into what you're working on right now on your latest Substack, which I encourage people to follow, John. And obviously, I'll put all the links below. But what is grabbing your attention right now?
Well, right now I'm working on a piece about real estate, and the premise is, which domino is going to fall first to blow up the U.S. housing market? Because there are several things that look like they can go very wrong very quickly, and maybe in the order that it's affecting my life. First, baby boomers are aging. And the average baby boomer is now like 70 years old. And we, my generation, own the majority of the houses in the US and the vast majority of the big, expensive houses. So in my neighborhood right now, I live in a neighborhood of, there's a lot of retiree couples here. And something is happening. It seems like an accelerating rate, or actually two things. One is that one husband or the wife in a given couple dies, which is statistically normal once you get up into your 70s and 80s, the way a lot of these guys are. And then the remaining spouse immediately puts the house on the market. They don't want to live in that big house anymore with all the memories and all the maintenance and everything, so they sell the house, or they decide to move because the grandkids are far away and that's really their life right now. They want to be with their family and everything in their last 15 or 20 years or whatever they have left. So they put their house on the market. So lots of houses are going on the market here. But these are boomer houses that they've been in for a while and they're massively appreciated and they're expensive. So who's buying them? Who can buy them? Because most of the succeeding generations that came along after the boomers don't have anything like the kind of money that it takes to buy a McMansion right now. How many people in the country who are under the age of 40, let's say, can take on $1 million mortgage? Very few, and so it's highly likely that we see this tsunami of boomer houses coming on the market in the next few years with nobody to buy them. And that craters the price of McMansions and other highly appreciated houses. Another group that might all be almost as consequential are the Airbnb guys, because Airbnb started out just like a decade ago, right? As this little thing where you rent out a room in your apartment or a tent in the backyard or something, make a little bit of extra money, and don't really think that much of it. But it kind of metastasized over the years into this algorithm driven, entrepreneur dominated, people with 15 or 20 apartments or houses and things like that, or where the personal touch is gone. You don't actually speak to the people who you're renting from, and they certainly don't invite you to dinner. My first Airbnb, I rented an RV, and the owners lived nearby in another RV. They invited me over to dinner. We hung out and made friends and everything. It was a much nicer experience than a hotel. But now with our Airbnb, there's all these extra fees that the algorithm is generating, and it's impersonal, and it's, all things considered, more expensive than a hotel in a lot of cases. So people are just saying, why bother, And so real estate developer friends of mine say they have never seen so many Airbnb units come onto the market as right now. And that's, there's several million Airbnb units in the US right now. So if they start coming onto the market, that's a big number, and it's a number that's consequential enough to move prices down dramatically. Now, the last group is the poetic justice group. It's the Wall Street guys, the private equity people who've been going around and buying up houses all over the country, sometimes buying up whole neighborhoods at 20% over list price, and turning them into rentals at much higher rents. So they're basically doing the private equity thing where they move in, dominate a business, and totally ruin it. And they're also doing the Wall Street thing where they overpay for bubble assets and then get crushed. So when house prices start moving down, which they are right now in some cities to an extent, all these houses that were bought by private equity guys with 0% loans, but that have to be refinanced at some point in the not too distant future, are going to get crushed. And they're going to do what Wall Street always does, which is to panic out of the market that they panicked into the decade before. And so that's a lot of units coming online right now. And so we're going to see this absolute tidal wave of houses for sale over the next few years. And there's not going to be anybody to buy them at today's prices. So prices are going to have to crater. The cost of owning a house or buying a house has to go down by 40%. So you either need a drop of 40% in the price of the house or a dramatic decline in mortgage rates, which takes us to the bond market and everything. But the immediate impact of this is going to be a big drop in house prices and a lot of bankruptcies on the part of people who bought at the peak and can't afford their house and have to hand it back to the bank or whatever. So the housing market is on the verge of something not exactly identical to the bust that happened in 2006, 2007, 2008. But that might have a lot of the same impacts on the country with an awful lot of people defaulting on their loans, an awful lot of banks being hurt by that, and then maybe some kind of bank bailout at the end of the process. So, fascinating thing to watch as long as you're not immediately affected by it.
So a couple things that pop into my head as you just described those bullet points. One, the Airbnb, I find it because I share with you I live in Phoenix, and I started to question the last Super Bowl was here, because everybody they wanted to put their property on Airbnb, up for rent the week of the Super Bowl and make a killing, right? Charge 200% over what their mortgage would be, or even if they rented a place, they would rent out their rental for the week for the Super Bowl. Well, the last time it was here, which was 2 years ago, I think, there were so many Airbnb, so many properties that were available that were not able to be rented out. And that was like an indicator to me. I was like, oh, maybe this thing has finally peaked, because to your point, there's units everywhere. And it reminds me of when I moved here in '06, like everybody was a realtor. Everybody owned 3 or 4 properties. They had regular jobs and they just kept buying properties. 100% loan to value, take out the equity, buy another property, another property, another property. It's not sustainable. This episode is brought to you by McIlvaney Financial Group. Their advisors bring a depth of knowledge and experience that allow them to serve their clientele with care, ensuring their financial needs are met now and in the future. Personally, I'm not saying cash is worthless, but you can see what's happening. It's worth less every year. Gold is the opposite. Click on the promo link in the show notes or go to www.mcilvaney.com/coffeeandamike.
No, it's absolutely not, because first of all, it's done by amateurs, so they're making their beginners' mistakes with hundreds of thousands or millions of dollars. And second, they call it passive income in the Airbnb world, which sounds like you just invest the money and you don't have to do anything else. But if you've got even one Airbnb unit, that's a lot of work and a lot of risk. You got to make sure that it's clean afterwards. And then if it's not, you have to charge them extra, yada, yada. And, one Super Bowl party, let's say, in your apartment can do a lot of damage. What if they break your stove? And then, okay, you made some money by renting to them during Super Bowl week, but you have to replace your oven, and that's $1,500 or something like that. So that it effectively wipes out all the extra profit you made by renting your house or your apartment out over Super Bowl week. And then, and you have to stay somewhere while all that's going on. So it turned out to be not a nice lifestyle to be an Airbnb landlord, and also not nearly as profitable as people thought. So what you're going to see now is, first of all, a lot of people not being able to make their nut. In other words, they can't pay the interest on the loans that they took out to create this little Airbnb empire. And they're going to have to start selling off inventory in order to cover their day-to-day bills. And if they can't do that, they have to declare bankruptcy. And then the bank takes over and, you know, shoves those units out the door for whatever it takes to clear the market. And that's an almost given now because so many people are so disgusted with the Airbnb experience that they're going back to hotels. And, I'm one of them. I would never do an Airbnb now where I have to clean the place before I leave. When you're traveling, you're on a schedule, and an hour is an important thing that maybe it isn't to most of us who are just sitting in our houses right now. But if you've got to be somewhere because you're on your vacation schedule or your work schedule or whatever, you don't want to spend an hour cleaning your Airbnb before you can get out of there. And with a hotel, you just, you stop at the desk, you hand them your key, and you walk out the door. And you cannot put a price on that kind of convenience now. So I think hotels are going to take back all the business that Airbnb stole from them over the past decade. And that's not going to leave that much for the Airbnbs that are out there. And you're just going to see a wave of bankruptcies, which inevitably lead to lower prices for the real estate, which means, if you're in the market for a house or a condo and you're in a place that has a lot of Airbnb activity, wait a year or two and watch the cost of your dream house go down in value dramatically, and you'll get a much better deal. It's just if you can wait, this is a time when you should wait. This is 2006 all over again. When terrible time to buy, spectacular time to rent for a couple of years while you're looking at exactly the right unit to buy once it crashes.
Well, what are your thoughts? Well, first of all, people that are homeowners in areas where there's lots of Airbnbs, they're probably so glad when these foreclosures start. Because I couldn't imagine living in a cul-de-sac where you've got a couple of Airbnbs next to you because you don't know who's coming in every single weekend.
Yeah, I forgot to mention that Airbnbs ruin neighborhoods. That's right. You don't want to live around party houses, right? And there's a lot of cities are starting to impose really strict rules about Airbnbs, and to the extent that some of them are just banning the whole concept altogether. And that's in the court system now. It's not clear whether a city can do that. They're trying because it, first of all, drives rents way up and drives prices way up because it limits the number of houses you can buy if everybody's buying Airbnbs for rental. So it just, makes a place a lot less livable. And one way or another, there are going to be extreme limitations put on the Airbnb model, the whole sharing economy real estate model in the future.
What are your thoughts then, as private equity, as you discussed? And I was just reading an article about technocracy that was sent to me this morning, and Patrick Wood, I think he was the author of it, but and the build to rent model, and it was in the article it referenced, Berkshire Hathaway has made this investment into D.R. Horton in Lennar, predicting what the future would be, and it would be this build to rent because, to your point, people can't afford homes right now. So Wall Street is coming in, buying up these homes. They'll charge you less. Let's say your mortgage is, I think the article said, let's say a mortgage would cost you $2,500. Well, you can rent the same home for, say, $2,100, $2,200, and they're buying up these streets, and that this is what the future of living is going to be in this country, to the point where by 2030, I forgot the percentage off the top of my head, but it was like a large percentage of people will be living in build-to-rent models.
Yeah, well, that's definitely the trend. But I think the next few years are going to see a lot of those build to rent entities, the companies that are doing this stuff, being able to make money at it and go bankrupt. The banks are going to take over that real estate and they're going to turn around and sell it. So I think we're headed for right now. It's a very hard time to be buying a house for sure. And not an easy time to rent because rents are so high. But we're going to see a lot of foreclosed real estate come back on the market. And so we're looking at a pretty good time to buy a couple of years from now, especially if interest rates stay high, because that'll just turbocharge the process where nobody can refinance or anything. And, in 2008, 2009, especially, for instance, in your area, Phoenix, but definitely in Florida, places like that, there were just massive numbers of foreclosed homes for sale for really cheap, really low prices compared to what they were at the peak of the bubble. And I suspect the same thing is coming right now. So, we might end up being mostly renters 5 years from now, but there are still going to be a lot of opportunities for home ownership if you time it right, and if you have access to the money to just come in and swoop up or scoop up a nice house that a bank is desperately trying to get rid of.
Yeah, because these financial institutions don't want to hang on to these assets. What are they?
No, that's not a bank's job to be a landlord. They don't want to own real estate, so they'll just shove it out the door as quickly as they can. And so they're open to lowball bids and other kinds of offers. And I've known a lot of people over the years who found really, reasonably nice places at extremely good deals compared to today's prices. They bought something in 2009 and it's tripled in price in the ensuing decade and a half. So, uh, same thing coming probably.
What do you think Berkshire Hathaway is thinking then, making these investments into these home builders?
Well, they like um, good quality businesses with moats around them. So, what they might be envisioning is a tough housing market putting all the marginal home builders out of business and leaving the financially strong ones there to be vultures, to pick up all the raw land that the smaller home builders bought but can't maintain, and buy lots of houses that are like half built and before the company went out of business. There will be a lot of opportunities for financially rock solid home builders in that kind of a market. So that might be the play that Warren Buffett is looking at. I really don't know. It's hard to believe that just the standard business of any home builder is going to be a good one in the kind of market that's coming. Assume home sales. Well, they're still at incredibly low levels right now. So not a lot of homes are selling, but let's say the prices start to drop dramatically. Well, if you're building new houses, then you're in competition with existing houses whose prices are being cut by panicking sellers. So you've got a problem on your hands. So you have a couple of very tough years, maybe 5 really tough years. But meanwhile, your weaker competitors are all going out of business, which creates huge opportunities for you. Yeah, so I think that could be the play, and I think that with a long enough time horizon, it's a very good one.
Now, with private equity, I mean, the rumor is that Powell is going to do a rate cut next month, and within, I don't know when the new Fed chair gets announced, 6 or 7 months, I believe, April, May next year. Whoever that is appointed, I've heard the rumors of possibly Judy Shelton, and
Mm-hmm.
others, but will that give private equity a new, what is it, a new life with rates dropping, and they'll be able to start swallowing up things again?
Well, see, the bond market is the key player in this process because what happened the last time the Fed cut interest rates in September of last year, um, short-term interest rates went down according to the Fed decision to cut overnight lending rates, but long-term interest rates went up. In other words, the bond market said, "Nope, I'm not going to lend you 10-year money at the current rate if you're going to start cutting interest rates, which might just blow up or blow up the dollar. If you're going to do things that are designed to inflate away the currency, then there's no reason to be lending long-term money." So interest rates went up. Now, will they do that again? I think they're going to tend to, because here's one scenario. We cut short-term interest rates this month and then continue to do so in every monthly meeting after that. That lowers short-term interest rates. So if you're borrowing money for like a week or a month, you get a better deal. But the bond market rebels against this process, and interest rates start to go up at the long end of the yield curve. In other words, 10 years, 20 years, 30 years, interest rates go up. And that's a catastrophe for an over leveraged economy. So the government is then forced to come in with QE and yield curve controls and stuff like that, things they did back in 2007, 2008, 2009, to try to push down long-term interest rates. But they're doing it on a much bigger mountain of treasury paper that's out there, which means they have to create that much more currency, which might just shift the pressure over to the dollar. In other words, they push long-term interest rates down with a lot of money printing, but then nobody wants to hold the dollar anymore, and see, that's the end of this process. By the way, I ran a website called dollarcollapse.com for a long time. So I've been explaining this part of the process since like 2004. But at the end of this process, when everything else has been attacked by the government, the government is using newly created currency to basically keep every other part of the financial system in line, the dollar starts to fall in a disorderly way. And that's basically the end of the fiat currency experiment, because it means the Fed is out of tools with which to manipulate the economy. Because the only way you can stop a currency from falling in value is to raise interest rates. But we have so much debt now that it's impossible to raise interest rates without blowing up the leveraged speculating community, which is all the people we just talked about, Wall Street landlords and Airbnb entrepreneurs and home builder companies and boomers who are trying to refinance or sell or whatever. We blow up that whole sector of the economy, and put ourselves back into a 1930s style deflationary depression. And we can't have that. So all that's left to do is basically just to accept the value of the currency plunging and maintain low interest rates as the currency drops. And that basically leads to hyperinflation. So we're on the verge of a very difficult choice, but one that is absolutely going to be, faced with a 1930s style depression or rising inflation. We're going to pick inflation. And there's no real end to a process like that other than a currency reset where it just breaks. The global fiat currency experiment ends with massively crashing financial asset prices and spiking bond yields. And the governments of the world have to step in and come up with a new monetary system. So I think that's the latter half of this decade. That's the big story, is where we try to come up with a new financial system that is sustainable, that allows us to go back to quote unquote normal growth going forward. And that's not easy, but there is a historical template for it, and that is a gold standard. The simplest way to do a currency reset at this point is just to declare that the dollar is now just a name for 1/10,000th of an ounce of gold, or 1/20,000th of an ounce of gold. And that takes away the government's ability to create new currency and inflate away the existing currency going forward, which means they have to give up the best power in the world. I mean, if you could create money out of thin air, would you ever give up that power voluntarily? Never. And governments won't do it unless that's the least bad option on a list of horrendous options. So I would say, real estate can play a big part of us getting to that process, but there are lots of other bubbles that will burst along the way. They call this the everything bubble because many things are in bubble territory right now. And when one bursts, it's basically a domino that knocks all the other ones down. And the governments of the world know that. So they're standing ready to bail out basically anybody big that gets into trouble at the cost of inflation. And they know that too. So it's one of those no-win situations that these guys find themselves in. And they're just, in a lot of cases, trying to get through it to retirement so they can take off and leave it to their successors. But there is no fix for any of this that isn't incredibly painful one way or another.
Well, and that's where the global monetary reset that I feel we're in right now, because the dollar continues to be devalued, and Stephen Moran recently being appointed at the board, and this whole with the Mar-a-Lago Accord. and the direction. I have had people on. They've explained to me like I'm 5 years old, John. I still don't understand it. I don't like the stable coins, how that's going to potentially play a part, and then gold-backed securities on the back end.
Nah, none of that works because you're still financing your way out of a mountain of debt somehow. You can come up with a central bank digital currency or stable coins or what was the other thing you mentioned?
The gold-backed
Um,
securities.
yeah, gold back. Yeah, they're talking about 50-year gold backed bonds. Well, first of all, who would lend money to a government for 50 years if you have to trust them to give you gold back at the end of the process? Because in 50 years, nothing's going to be like it is now. Um, and stable coins, same thing. A stable coin is basically you put a bunch of treasury bonds in a quote unquote vault and you issue a cryptocurrency that is tied to the value of those treasury bonds. And that currency trades on a blockchain. And I think the hope is that lots of people who wouldn't now buy treasury bonds will buy these stable coins in the crypto market. And that will mean extra money coming into the treasury with which to finance their deficits. That's not going to work. That is just absolutely not going to work because it all comes from the same pot. If crypto guys give money to the treasury market, then they've taken money out of something else, which is probably a bubble, which will probably crash and then cause the government to have to bail that thing out with newly created money. So now there's no fix that doesn't involve a radical transformation of the financial system that, as its absolute prerequisite, takes away the government's power to create new currency out of thin air. So a gold standard does that. If you just say, gold and the dollar are exchangeable now at the official rate of 1/10,000th of an ounce of gold per dollar. That stops the government from being able to create new currencies. But this other stuff, and they're just experiments on the way to the end of the big experiment, and they will not work. They might make a lot of money for traders in the meantime. So if you're somebody who likes to go in and out of highly volatile assets, then these things might be tailor made for you. But if you're trying to invest long term to protect your purchasing power, you need real assets. Just ignore all this financial noise and buy gold and silver and oil wells and farmland and really well chosen rental houses, things like that, and those things have utility and they will hold their value while these experiments play out and the dollar tanks and all the crazy stuff that's coming happens. And if you do it right, if you're a successful stacker, for instance, and you end up with a ton of silver, literally maybe, you're in a position to help your friends and family out because they probably didn't do the same thing, and they're hurt more badly than you are by the process. So you can be the protector for your family if you do this right, even if they don't listen to you and think you're a crazy prepper or whatever. You still have a chance to get this right. And that's kind of what I do on my Substack is look for actionable advice for surviving and thriving in this kind of a crazy financial environment where everything we thought we knew stops being true.
What were your thoughts when you first got introduced to the idea of crypto, and what are your thoughts on it now, especially as this administration has been praising it so highly, forming a team with David Sachs and whoever else he's got, Scott Besson and Howard Lutnick and
I love the concept of cryptocurrencies because it's technology-based money that, in theory, is independent of the government regulatory apparatus, and that's a very cool idea. But I don't see how it stays independent of regulation. For one thing, I mean, these stable coins that are coming out are highly regulated by definition. And I worry that, well, first of all, that I just cannot understand how something that doesn't physically exist can ever be money. And I could just be an old guy who doesn't understand new concepts. It's completely possible that it's 1890 and I'm sitting in a horse-drawn carriage and I'm looking at the first automobile going, nah, I don't understand it. It'll never work. So maybe we end up on a Bitcoin standard instead of a gold standard. I don't see how that works, but um, an awful lot of money and an awful lot of smart people are in the crypto market right now. And I wouldn't presume to say that I'm smarter than them. So it's possible that cryptos end up having a big role in the coming new financial system, but I won't be participating because I can't really understand how that works. I'll just be sitting there with gold and silver and hoping that they hold their value as they have for the last 3,000 years.
What are your thoughts? As long as you've been talking about this, writing about it, and here we are now in 2025. This last quarter of it. What do you see by the end of this administration in terms of how for regular people what their life will be like?
I think for regular people, the kind of financial crises that are coming are really dangerous because, for instance, if you trust the government, the people who are going to be hurt most by this are the ones who trust the government. And that is to say, if you hold a lot of dollars, for instance, in a bank account or savings account or something like that, those dollars will become less valuable and you'll become less rich. If you own a lot of government bonds in your 401k or your IRA, and that's the income for your retirement, well, those bonds are going to become a lot less valuable as the dollar that they depend on for their value goes down in value. So, I think regular people are going to be hurt very badly by this. And if you're in the stock market, stocks are going to be incredibly volatile. I mean, they might actually go up in an inflationary environment, but they might go down 60% in corrections before they go back up. So the old 60-40 portfolio of 60% stocks and 40% bonds is not as sure thing as it used to be. There was a time when, well, actually, ever since 1971, when we went off the gold standard, a 60-40 portfolio was excellent. It made money for baby boomers, my generation, all the way through to the present day. And I think that changes going forward because that 60-40 portfolio depended on bonds to be the stable part. In other words, the safe money was in the 40% that was in high quality bonds. Well, bonds are going to lose a lot of their value in what's coming. So you're dependent on your stocks, which are hugely volatile, to keep you afloat. And it's very easy to envision an equities bear market and a bond bear market happening at the same time in the kind of crisis that's coming. And that means you lose money coming and going. If you've got a 60-40 portfolio, you can easily lose 50% of your nest egg. And if you're 71 years old and you really don't have 20 years to make that money back, your life just changed for the worse in a really dramatic way. So I think those are the people who are going to be hurt most dramatically by this, and they're the ones who least deserve it because they're trusting the advice they get from the experts. And that expert advice was give credit where credit is due, exactly the right advice for all of our lifetimes. It's just that it may not be the right advice going forward. And so that's a hard thing especially if you're old enough to have a retirement account. It's a hard thing to learn something completely new like that. Like the truths that got you here may no longer be what you thought they were. And so it's a hard sell to tell people, wow, get out of bonds, get into gold, something like that. But I think the people who do that are the ones who come out of this in the best shape.
Well, and you said something that just really resonated with me because we are in a different time now than what we were 20 or 30 years ago, and some people just can't come to grips with that. And it was 20, 30 years ago, even 20 years ago when I got out of college. You got a job with a corporation, you put money in your 401k, you maxed it out, and then over time it would grow, and then you hit a certain age and you would retire, and that 401k would just be sitting there for you. Well, that's not the case today. And what do you expect, especially how this country's become such a service-based economy, the jobs market in the next 3 to 5 years?
Jobs, it's a really interesting subject because you got two different strains of thought among economists. One group says, well, artificial intelligence is automating so many jobs that we're going to have all these out of work people who have no skills and no ability to make a living. And what are we going to do then? And then there's another group of economists saying, well, our birth rates are so low that we're running out of workers. There are not going to be enough workers to support our retirees going forward. And, you look at Japan or South Korea or much of Europe, they're basically zeroing themselves out. Their birth rates are so low, they're ceasing to exist as cultures. And so those are two mutually exclusive worldviews. And it's possible we kind of go right down the middle where, yeah, AI automates a lot of jobs, but because of lower birth rates, we generate fewer workers and robots just take over a lot of jobs and we end up being all right. Everybody has a job who wants one. But I don't know. I don't know what AI is going to do to the jobs market because I think nobody knows how far it can go, how smart artificial intelligence can get, how competent. And we'll find that out over the next 5 or so years. And we also don't know just how far down birth rates are going to fall or if they're going to turn back around. I think governments are, they're aware of the fact that they're running out of people because births are lower than deaths now, and they're taking steps to raise birth rates. And we'll see if there's a strategy that works for that. I think everything has a price in life, almost everything. And it's going to turn out to be just how much do we have to pay per baby? And I think it's going to be a very high number, but it's a finite number, and it's probably less than the problems that flow from a collapsing birth rate and declining population. So we'll see. Long answer to maybe what could have been a short question, but I really don't know what the employment market is going to look like over the next 5 or 10 or 20 years. And I think a lot of that is technological and a lot of the rest of it is demographic. And those are inherently kind of unpredictable. So, again, if you're younger, and you're choosing a career, you absolutely want to look into what can and can't be automated, and you want to go for the stuff that cannot be automated. Like if you're 18 years old today, become a plumber, become an electrician. Those are things that won't be automated away, and they're in massive demand. So you make middle class or upper middle class money without even going to college. You don't have student loans or anything. You're making serious money. Everybody wants to hire you. And that's a pretty good life if you just get the idea out of your head that you have to have a college education to be a legitimate person, because you do not going forward. You need a trade that is in high demand. That's the definition of high status going forward. And so that's something that, regardless of how all this stuff plays out with demographics and AI and everything, that's something you can do and have a high probability of success going forward.
I was talking to Melody Wright a couple of days ago, and the subject of AI came up, and she said something that was different than what I'd heard in regards to maybe it's a smokescreen for our ailing labor market. Maybe all this promises of all these things that AI can do, and it can't do it. I mean, I was referencing healthcare. There's all this AI out there, companies that can provide all these solutions to healthcare, but when you get down to it, they put these PowerPoints and videos together showing you the solution, but it can't actually do it. So it makes you think, oh, maybe this thing is all a smokescreen and it's just not there yet, the way they're selling the sizzle right now. Because AI is a very sexy term.
Yeah, what it looks like with AI is that you can approximate right answers, but there's a big element of error in the solutions that come from AIs right now. And the amount of processing power that it takes to get to error-free borders on the infinite. So there's this fundamental flaw that keeps AIs from being the perfect solution to lots of problems. So the question is, what can they do? and how well that can they do it. And I still think there's a lot of there are a lot of jobs that can be automated, and that's happening right now. By the way, a lot of tech companies are laying people off, and they're blaming AI for it. I don't know how much that is, like you said, a smokescreen for other issues. But there seems to be a lot of automation going on already via AI that's costing a lot of people jobs. For instance, computer programming, the bottom rung or two in the programming market is being automated. It looks like there just is not work like there used to be for entry level programmers. That's a very big deal because that's the fallback job of the past 20 years. If you lose your job, learn to code. And apparently that's not good advice anymore. So yeah, this so much of this stuff is inherently unpredictable because, for one thing, with AI, you don't know what is going to happen when AIs that are able to teach themselves are basically just turned loose to learn and grow and progress. Do you create a small g god at that point, and does that god then take over the world? I don't know. And or do you create something that's just very, very good, artificial general intelligence, good at lots of things, So you create somebody who can, or something that can do many different jobs and can just surpass the people who are doing those jobs right now. We'll see. I think that's going to coincide, interestingly enough, with the gigantic financial crisis that's coming. So we have multiple things happening right now, and then you've got geopolitics. Okay, so we've got AI doing what it's doing, and we've got the financial system that's breaking down, and you've got a very chaotic world right now, where, for instance, Europe looks to be on the verge of civil war. And that's because, we don't need to delve too deeply into immigration policy and stuff like that. But suffice it to say that you got a clash of cultures now in a lot of European countries. And the government seems to be on the wrong side of that argument for a lot of the people in those countries. And so they're massively protesting. On September 13th, there is a march scheduled on London, and the predictions now are for like 1 million people to show up. And there's going to be three different groups of people, pro and con, and in the middle, showing up for this thing. So it's not like one group of people taking over London. It's three or maybe multiple groups who don't like each other, and then together they outnumber the cops probably 100 to 1. So we don't know what that's going to turn into. And same thing in, for instance, Germany, where the most popular political party wants to flat out close the borders and pull Germany maybe out of the Eurozone. So you get that, and that is an earthquake economically for Europe. And Europe is a big, consequential global economy. And so, that's extremely unpredictable when you've got stuff like that happening in a big economy out there. So who knows where all this leads? I mean, it all comes back to being extremely cautious with your money in this kind of a world, because you don't know what you're going to wake up to find happened on the other side of the world while you were asleep, and everything has changed. So I think the people who are best prepared for all of this stuff are the preppers, the people who are just learning skills that they're going to need and acquiring assets that have utility. I think they come through this in the best shape. And then people who are depending on the big systems continuing to take care of them, they're the ones with the really serious problem.
Can you believe, where we're at with all this? I mean, as long as you've been doing this work and following it, I mean, you obviously saw something back in 2004 with dollar collapse, but look, we're here, John.
Yeah. Well, I clearly saw what was coming way too soon, And it's funny, a guy named James Turk, who you might know as the founder of Gold Money, who's a big name in the gold space. He and I co-wrote a book called The Coming Collapse of the Dollar and How to Profit from It in 2004. And our biggest fear while we were writing that book was that the system would break down before we got the book out. We were afraid 2005 was the end of the fiat currency experiment. And we managed, we had that near death experience in 2008, but we managed to struggle through for another 20 years from then. And so, when I say, "Oh, this is coming in the next couple of years," you got to keep that in mind. That my record of predicting timelines is seriously flawed. But we are doing all the things that lead to a gigantic financial crisis and the end of a currency regime historically. It's not like this is new. The only thing that's new about it is it's global. Everybody has a currency that they're inflating away, but countries have blown up their monetary systems over and over again throughout history. They borrow too much money, they create too much new currency to cover their borrowing. That crashes the value of the currency. They have a gigantic financial crisis, and then they reset their monetary system. That's happened over and over again. And the difference this time is that those previous financial crises happened in a sound money world. Everybody else was on the gold standard. So if you blew up your currency, it was fairly fixable because everybody around you was basically okay. This time, nobody's okay, or almost nobody's okay. And so that's what makes what's coming different. And that's why we were able to keep it going for so much longer than seemed reasonable back at the turn of the century, because everybody has a printing press. So they're all able to create massive amounts of new currency to kick the can down the road with. And it does seem like we're running out of that road. We're coming to the point where there's just a crossroads now, deflationary crash or hyperinflation. But yeah, it took much longer than seemed reasonable. But I'm willing to go out on a limb now and say, we can't do this much longer. I mean, you look at gold; it's heading for $4,000 an ounce, and silver could be $100 an ounce in the next couple of years if the relationship between those metals holds up. Those are signals that the system is breaking down, and I think those are signals we ought to heed if we're trying to protect ourselves.
I know I'm running out of time here with you, but one last thing I want to ask is how will China, Russia fare through all this? Could they escape this with minimum damage, or how will they be
Russia,
impacted?
maybe. Well, Russia kept its finances in great shape going forward, and they've got a lot of oil. So they fit the profile of a society that isn't as threatened by this as a lot of other countries are. China, on the other hand, has a massive demographic problem. Their birth rates have cratered, and they got themselves out. They got the world out of the Great Recession by basically quintupling their debt and creating enough currency to make that debt viable. And now part of that was a gigantic real estate bubble, and now that bubble is bursting. So China has a problem that's similar to Europe's and America's and some of the rest of the world, where they've got a mountain of debt. What do you do with it? There are limited amounts of things you can do to fix massively over indebted financial systems. So yeah, Russia may be okay. China probably not.
Japan probably not either, right?
Who?
Japan.
Oh, Japan. No, no. Japan has more government debt per capita than as a percentage of GDP than any other country in human history, and their population is crashing. So yeah, and they imported a lot of Indians. They decided they would have a lot of immigrants come in as a way of propping up their workforce in order to allow their retirees to continue to collect their version of Social Security. But that's causing civil unrest there now. They're having riots because of immigration. So it's not clear whether that turns out to be a strategy that works for them or not. So we'll have to see. But they have to do something if they don't want to just cease to exist as a culture, because we'll just run out of Japanese at some point, and not in the not too distant future. They're decreasing their population at an accelerating rate, and you can't do that for very long and still be a viable country.
John, where can people find you?
I'm at rubino.substack.com, and I publish a newsletter there that looks for actionable advice for the stuff we just talked about.
I encourage everybody if they're not already, follow John, become a paid subscriber, support what he's doing, And thank you for doing this, and look forward to continuing to follow your work, watching you on other shows, and love to have you back on.
Thanks, Mike. Look forward to it.
Mic drop.